Welcome everybody to this webinar today, where we'll be talking about one of my pet hobbies, the minimum terms and conditions which apply to chartered accountants' professional indemnity policies. Now, for those of you who don't know me, I'm David Gooding. I'm an insurance partner. I work in our Birmingham office. I'm speaking with my colleague Giverny Wroe, who's an associate in our Leeds office, and we both work together in our national accountants team. The session's being recorded, and whilst you can see us, I'm afraid we can't see you. We hope to have a time for a Q&A session at the end, so please do post any questions you have in the chat box as we go along. My colleague Harriet Strevens will collect them all up and present them at the end, but if we run out of time to answer all the questions, don't worry, I promise Giverny and I will pick them up and respond to you separately by email afterwards. Okay, think of this as a bite-size and thematic overview of the ICAEW minimum terms, with a few tips as well thrown in. We will unashamedly not walk you through any detailed policy terms. I can also see from the attendee list that there's an eclectic mix of you from around the accountants insurance world, representing claims, underwriting, broking, some accountants thrown in as well. Interestingly, we've got some lawyers from the ICAEW professional indemnity team who will also be keeping us on our toes. Okay, so let's start with Giverny and a backdrop to the minimum terms.
Thank you, David. So we thought it'd be helpful just to start the cover talk with a short discussion around some of the key requirements in respect of accountants' minimum terms. So my part of the talk is probably going to be more focused on brokers and policyholders. So let's start off with, what are they? Why do we have them? So the accountants' minimum terms are prescribed minimum terms, which the Institute of Chartered Accountants in England and Wales, so the ICAEW, provide for its members. So just to be clear here, in this talk, we're talking about the minimum terms and conditions for professional indemnity insurance for chartered accountants, so those accountants who are members of the ICAEW. So why do we have them? Well, essentially, it's the same reason really why we have the minimum terms for lawyers. It's to protect the public. So these minimum terms and conditions are driven by public policy. So, what have we got? So, essentially, you've got probably one of the most gold-plated and insured-friendly policies that you'll find anywhere. So that's a bit of the backdrop. I'll now talk you through some of the key points. So if you're an ICAEW member, you have to have a minimum level of indemnity cover. That minimum level is 2.5 times the gross fee income of the firm for its last accounting year. So that's including non-recurring income. It's just really important here for brokers and firms to make sure that they've got the right level of indemnity cover. So even though there is this minimum level, they need to double check this. And that's particularly important if you're engaging in mediation activities or you're doing any sort of probate work. So just by way of example, we have a client at the moment who hasn't had a claim for 30 years. They're a really well-run small practice. They've got indemnity cover up to £200,000, and we've just had a claim in for 1 million. So it just goes to show, you never know when the next big claim is going to come in. Brokers and firms just really need to make sure that they get that right. That's the first provision. The second provision is that there's a maximum excess allowed, which is £30,000, and that's per principal in the aggregate and as part of the sum insured. The third key point is that if you're an ICAEW member, you have to purchase your policy of insurance from what's called an approved insurer. Now, this is great because firms and brokers effectively have this list of insurers that have all been vetted, and that if you purchase a policy from them, that it's going to do the right job. There's a number of benefits to this. The first one for policyholders and brokers is that they know exactly where they need to go to get their policy and what they need to do. Also gives some certainty around capacity in the market. And finally, if you're an insurer and you're familiar with the accountant's minimum terms, you're going to find your way around these policies quite easily because they don't differ that much. So I guess it's a time saver there for insurers. So just finally, point 4 is just moving on to the minimum approved wording. So as I said earlier, you have this gold-plated set of minimum terms, and there's stipulated wording which insurers have to follow. The wording has to either be equal to or better than the minimum terms. So just here, if, for example, they want to depart from the wording slightly, they have to include what's called a difference in conditions clause. And what that means is that, you know, whatever we do to the policy and however we change the wording, it's not going to afford policyholders any less protection than would be afforded in the minimum terms. So just before I hand over to David, I just want to touch very briefly on changes to the rules. So just for those of you who have been familiar with the minimum terms for a number of years, the last update was on the 1st of October 2018. Now, it's really rare that the ICAEW make substantial changes to their terms, but there are a few key ones that were made in October 2018, so I just flag those, and they're just on the slide in front of you. I won't go into them. David will touch on them as part of his talk, but I just flag that there were those key changes, and there's a common theme with them really, in that it's just ensuring that the cover is really broad. So on that note, I'll just hand over to David, who will talk to you about his top key 8 issues to look at when you're considering coverage.
Thank you very much, Jiv. So what I've done is distill 11 pages of wording in the MTC into what are my arbitrary top 8 issues that I think an adjuster needs to know about. But I should say that I don't pretend that this covers the whole MTC, just hopefully give you a useful insight into some of the key things that you need to be aware of. So first up, does the claim fall to an earlier policy year? Now, you might think this is an obvious point for anybody dealing with a professional indemnity claim. What I would say is that the overwhelming number of disputes that I see between insurers on MTC policies relate to when the claim arose. Now, as this is a claims made policy, the policy will be triggered when the claim was first made, or when there is a notification of a circumstance which gives rise to a claim in a later year. So it's the policy when the circumstance was notified that will be triggered. Also remember that a claim is a written or oral demand for compensation or damages. So key checkpoint number 1 is just to be really sure when the claim comes in that you gather in all the relevant correspondence, and in particular that from the claimant's solicitors or the claimant directly to the insured, just to check whether the claim was made in an earlier year or whether there was a cert that might have been notified to an earlier insurer. Next key point, the insuring clause. Now, I've added this in slightly on a tongue-in-cheek basis because with these MTC policies, they are extremely wide, as Jiv's alluded to in the previous session. They include civil liability in connection with professional business anywhere in the world. So when a claim comes in involving some sort of civil liability, the backdrop is the chances are it's going to be covered. And this is deliberate, and it was slightly extended in 2018, and largely to catch the vast array of different work, different professional services that accountants provide to domestic and international clients and people. It'll include personal appointments like trustees, executors, sometimes insolvency practitioners as well. So just double check the schedule as to what's also included. Be aware that it does also include ombudsman awards. So when you're looking as to what is covered, not only do you obviously look at the insuring clause, but the flip side of the coin is you need to be looking at the exclusions. So these policies operate by essentially including pretty much everything and then stripping that out with various exclusions. I'm not going to run through all the exclusions. You've got some typical ones in there like trading losses, fines and penalties, employment disputes, personal injury claims, and so forth. I just wanted to hover over a couple of key ones that I find quite interesting. The first is around work done in the US. So remember what I said before in terms of the civil liabilities for anywhere in the world. Now they restrict that in the exclusion to there's no cover for work done in a US office of the insured or for proceedings in the US, unless, and this is quite important, unless it wasn't reasonable for the insured to assume from the work that it was doing for a client that that client might then go and issue proceedings against them in the States. So that's number one. And then number two, fraud exclusion. I'm going to come on to remedies in a moment, but it is quite difficult for insurers to decline cover for fraudulent or dishonest conduct on the part of the insured which gives rise to a claim. Essentially, what you need to do is establish that all the principals of the firm were dishonest, or if it's a company, all the directors, or an LLP, all the members. That tends to be only relevant where you've got a small firm, and typically you would operate that where there might have been theft by the insured from client, or where the insured's been involved in some sort of fraudulent tax avoidance scheme, typically where there's small firms. So when claims come in, just double check what falls within the insuring clause, what might be excluded, and if there's anything around sort of dishonesty, then you're probably going to need to get coverage panel involved at an early stage. Next point. I flagged sort of IFA and investment work, simply just so it's on your mind, in that many firms of accountants, they do have a separate IFA arm or an investment arm that they'll run as a separate limited company. Now, sometimes those companies will have completely separate insurance arrangements, but sometimes they'll be captured within the MTC arrangements, so they might get the benefit of the gold-plated policy that Jim was talking about. However, if you see a claim that comes in that looks sort of unlike an accountancy type claim because it's an IFA type claim, just check the schedule and you'll see whether there's any different excess limits or indemnity limits, or indeed whether the wording is included within the MTC wording. Next one, aggregate limits. I'm seeing this quite a lot at the moment, and it's one area where there's a little bit more latitude for insurers in terms of their drafting. It's quite important to double check when a claim comes in particular whether that claim is quite significant or whether there's been a lot of claim payments during the year, because insurers can either have an aggregate limit in the policy, so that might be, say, £2 million total amount payable under the policy in that year, or it might be on an each and every claim basis, 2 million for each and every claim. Now that can make a big difference where you've got large claims coming in and a volume of claims coming in. Just be aware that defence costs go on top of the indemnity limits as well. So if you pay out your £2 million, you're still having to pay defence costs on top. Next one, this is really around remedies. So has there been any late notification or non-disclosure? And again, this is another example of the gold-plated policy, because there are very limited remedies available for insurers, either to avoid, rip up the policy for breaches of the insured's fair duty of presentation, or for breaches of the terms and conditions of the policy, like late notification. So as far as the Insurance Act is concerned, you can only avoid where there's been a fraudulent breach of a fair duty of presentation. You can't reduce the amount of cover available. In terms of breaches of late notification or other policy breaches, again, the remedies are very limited, and they are limited to claiming some sort of prejudice in relation to the handling of the claim. So in practice, what does this mean? It means if the insured has notified a matter late, and they've got to notify circs and claims within a reasonably practicable time period. If they're late with that, and that has led to sort of claims handling prejudice, insurers will have to pay out on the claim and then seek some form of reimbursement from the insured afterwards. The best example of this is where the insured sat on a claim, hasn't notified it, and then proceedings get issued, and insurers have to incur additional costs instructing lawyers like us to deal with the litigation. There are other sort of remedies within the policy. There's a control clause where insurers can take over conduct of the claim. The insured can't make any admissions without insurers' written permission. Also, if there's a circumstance that should have been notified in an earlier policy year, and then a claim is triggered in the following policy year, the amount of indemnity that is available in the second policy year is limited to that which was available in the first year. I don't see that very often, but it has potential to be quite a sort of a brutal remedy for insurers to deploy. which takes us on to disputes. So inter-insurer disputes, or disputes between insurer and the policyholder, they must be resolved through an arbitration. There's an arbitration clause under the policy. The insurer that's dealing with the matter has to continue handling it, deal with the claim, advance defence costs, pending resolution of the arbitration, which would be binding. There's also a Queen's Counsel clause in there, so if the insured or the insurer doesn't want to defend the case, and the other side does, then you send the papers off to a QC who will make a binding determination. And then last but not least, I do get asked this quite a lot, what happens when a firm ceases to practice? Is there any run-off cover? Yes, there is. There's a facility for a 2-year run-off cover. And that's all the time we've got at the moment to cover on this topic. I could spend quite a lot more on it, but I think there's some questions to answer. And I'm going to hand over to you, Harriet.
Thank you, David. Yes, there are indeed. The first one I thought I might ask Giv to answer, if you wouldn't mind. The question is, do you think the accountant's minimum terms are here to stay?
That's a really interesting question, Harriet. Thank you. I mean, it's probably one that I can't give a definitive answer to. However, David is going to sit on the ICAEW PII committee from January, so perhaps it's something that he can answer for us then. My view is that I think they probably are here to stay. Just from a public policy perspective, really, I think it's really important that consumers not only have faith in their accountants to do the work, but that they know that if things go wrong, they have that indemnity insurance behind them to sort of, compensate that. So I think they probably are here to stay, just purely from a public policy perspective. I think the only sort of change might be is if, for example, there's a current tsunami of claims in the current economic climate, and there's a loss of capacity in the market, that could potentially lead to a change. But I think that's probably a talk for another day.
I'm sure you're right there. Thank you very much, Giv. David, you flagged aggregation and to check whether there is an aggregation indemnity limit on each and every claim limit, or each and every claim limit. Can insurers aggregate claims on an each and every basis?
Yes, they can. And you would typically see in standard wordings across the market a clause whereby they aggregate claims that arise out of the same originating clause, or you might have, for example, the same act or omission in sort of similar backgrounds. So yes, you do tend to see aggregation clauses, but it depends on which insurer's policy you're looking at.
Thank you. You mentioned exclusions for dishonesty on the part of principals at the insured. If there's a sole principal you strongly suspect of dishonesty, say involvement in a fraudulent tax avoidance scheme, is it fair that insurers should have to keep paying defence costs until there is an admission of finding of dishonesty? What else can they do?
No, I don't think it is fair, Harriet, but the sort of strict letter of the policy says that insurers have to carry on dealing with the claim and await an admission or a finding. I don't think that's fair, but in practice, the reality is what happens is if there's an obvious theft by the partner, a sole practitioner, say at the firm, and he or she's disappeared, the chances are he's not going to make an admission, and insurers will just simply decline cover, having taken legal advice. And it's up for the partner then to challenge the decision through an arbitration, or the claimant to pursue a 2010 Act claim against insurers. But if there's an obvious fraud, that doesn't tend to happen. Alternatively, if you're not quite sure whether somebody's acted dishonestly, whether they've condoned, say, a fraudulent tax avoidance scheme, insurers tend to instruct us or other coverage panel to carry out a dishonesty investigation. That's a topic for another day, and I've got another checklist on that if anybody's interested. But you would then typically instruct leading counsel to cross-examine the insured, and if he or she thought the insured was dishonest, then they would decline. So there are practical ways out, but which aren't strictly within the letter of the policy.
Thank you very much. We've just got time for one more question. Given this magnificent gold-plated policy that exists, akin to others in the profession of the legal side of things, do you find accountants are generally prompt in notifying circumstances and claims? One might think that they would feel they didn't need to, given the cover is so strong?
Well, that's a good question. Actually, if we were all sitting in our Mills and Reeve office in London, I would put that one out to the underwriters and the claim teams in the room. But from my experience, and just bear in mind, there's something like 133,000 registered ICAW members in the country, and they're all quite different. But in my experience, accountants are pretty cautious and risk averse, and they tend to be fairly prompt notifications. It does depend on the firm, but in my experience, they're pretty good about that. And so, notwithstanding the fact that there are limited remedies available to insurers, I do wonder how much they would deploy them in any event.
Well, that's all we've got time for today, in keeping with our usual aim of finishing as quickly as we can within the 15 minutes allowed. So I'll back to you, David, to close up.
Thank you very much, Harriet. As you say, that's all the time we've got just now. We'll endeavour to respond to any other outstanding questions by email. And I'm very grateful for you all joining us. And if you'd like a more detailed approach to this particular topic or other wordings for accountants, non-ICAW members, just drop me or Giverny a line and we'll come back to you. Have a very good day and thank you very much.